Ladies and gentlemen, thank you for joining this call, and I wish you a good evening. I welcome you to our conference call for presentation on the bank's performance for the third quarter of the financial year 2018. On this call, along with me, are Mr. V. Srinivasan, Deputy Managing Director of the bank, Ms. Rajiv Anand, Executive Director, Retail Banking, and Mr. Siddharth Rath, Group Executive, Corporate and Transaction Banking. At the end of this presentation, we'd be glad to respond to your questions. For some parts of this call, we expect to refer to slides in our quarterly investor presentation, so you might want to keep the presentation handy. Let me start with the key highlights of the quarter. Loan growth during the quarter was strong. There was pickup, which was visible across all segments. Our retail franchise continued to deliver in terms of a healthy loan growth, fee growth, and average CASA growth. Our leadership in the digital space continued with a #1 rank in mobile banking spends and volumes as per the latest RBI data, and being among the top players in UPI transactions as per the publicly available information. Our capital position is stronger post the recent capital raise, with the Tier 1 standing at 14.13% and book value per share at 256 rupees, up 12% YOY. Operating performance has been steady. Core operating profit growth was healthy, and there was a moderation in OPEX growth along expected lines. Asset quality performance improved sequentially, with slippages declining 50% sequentially, gross and net NPA ratios both declining, corporate slippages predominantly coming from the BB and below pool, and provision coverage ratio improving to 66%. And finally, subsidiary contribution has been increasing steadily. I shall dwell on some of these highlights in greater detail as we go along. Let me begin with some brief comments and a perspective on the macro situation as it looks to us for Indian banking today. Economic growth recovered slightly in the second quarter, rising to 6.1% YOY on a GVA basis from 5.6% in the first quarter, mainly on the back of recovery in manufacturing, which offset some weakness in agriculture and services. Market rates, of course, firmed up noticeably during the quarter as liquidity conditions tightened. Further rate cuts at this point look unlikely, and the focus has now shifted to the upcoming budget. We remain cautiously optimistic in this environment. Continued gradual improvement in growth, coupled with tighter liquidity conditions, are likely to boost bank credit growth. Continued government spending on infra will help boost CAPEX, and the bank recap package is likely to allow for a more dynamic industry. In addition, the deepening of digital transactions does allow better data harvesting and new opportunities in areas that were previously out of reach of banks. With this macro backdrop, let me now discuss the bank's performance. Banking system non-food credit growth continued its upward trajectory from the multi-decadal lows witnessed in the March quarter and stood at almost 12% for the latest fortnight, partly aided, of course, by the low base of last year. Axis Bank's loan growth in this context continued to remain healthy and stood at 21% YOY, above our guidance of 5 percentage points over industry growth. Loan growth was largely driven by a 29% rise in retail and a 27% rise in SME loans. Corporate loan growth further picked up to 12% in the third quarter, up from 10% in the second quarter, with working capital loans growing quite strong at 49% YOY. The overall deposit growth of the bank during the quarter stood at 10% YOY, which has been partly influenced by the high base of last year. On the average balances basis, deposit growth was healthy. CASA deposits on a cumulative daily average basis for the quarter grew 21% YOY and comprised 46% of total deposits. Savings account and current account balances on a cumulative daily average basis grew by 18% and 26% YOY respectively. On a period end basis, savings account and current account balances grew by 11% YOY and 21% YOY respectively. Overall, CASA balances grew 14% YOY, and our CASA share in deposits stood at 49% at the end of the quarter. CASA and retail term deposits continue to form a strong base and stood at 84% of total deposits, up 228 basis points YOY. Term deposits grew by 7% YOY. Growth in retail term deposits was higher at 12%, while wholesale term deposits declined by 3%. Let me move to the bank's earnings profile, where I'd request you to refer to slide 14 of the earnings presentation. Net profit grew 25% year-on-year and 68% sequentially to rupees 726 crores. Net interest income for the quarter grew by 9% YOY. Net interest margin for the quarter was 3.38%, with domestic NIM at 3.60%. Year to date, the bank's NIM has compressed by 19 basis points compared to the full year NIM of FY17. Slide 16 in the presentation represents this NIM waterfall showing the 19 basis point compression. This compression remains in line with our expectations, and we reiterate our full year NIM guidance, which is an expectation of 20 basis point compression on a full year basis. Cost of funds during the quarter stood at 5.08% compared to 5.18% in the second quarter of this financial year and 5.51% in the third quarter last year. Fee income growth was healthy at 24% YOY and constituted 31% of operating revenue. I will reiterate that some of the fee income growth is also contingent and coming off of some base effect from the third quarter last year, particularly in retail fees. Retail fees overall, though, continue to be an area of strength with a growth of 35% in this quarter, and retail thus constituted 49% of the total fee income. Corporate banking fees in the quarter grew by 2% YOY. Trading income stood at 200 crores, down 87% YOY. Operating expenses growth for the quarter moderated to 12% year-on-year. The cost to average assets for the bank was flat at 2.17% for the quarter. Operating profit for the quarter stood at 3,854 crores, down 17% YOY, driven by the fall in trading income. Core operating profits rose 17% YOY. Provisions and contingencies for the quarter were 2,811 crores, down 26% YOY and 10% QOQ. For a detailed provision breakup, kindly refer to slide 68 in the earnings presentation. The bank's provision coverage ratio improved during the quarter and stood at 66%. Let me now discuss our performance in the key business segments, starting with retail. The strong retail franchise continues to drive our financial performance. If you refer to slide 23 of the earnings presentation, the share of retail loans in the overall loan mix continues to remain on an upward trajectory and stood at 46% at the end of the third quarter. Retail loan book remains well diversified, with nearly all major segments contributing significantly. The share of home loans in overall retail book has steadily come down from 54% in financial year 13 to 42% at the end of the third quarter, while the share of personal loans, credit cards, auto loans, and small business banking has inched up to 26% from 19% during the same period. If you flip over to the next slide, you will observe that the growth in the third quarter was led by credit cards, personal loans, and auto loans that grew by 46%, 44%, and 34% respectively. Our identified new engines of growth, like small business banking and education loans, continue to see strong momentum. In personal loans and auto loans, we continue to see traction on acquisition from digital channels and branches. Slide 25 of the presentation highlights the growth trend in retail fees over the last few years. At the same time, retail fees have increasingly become more granular and annuity-based. The share of fees from cards has been steadily inching up from 26% at the end of FY13 to 39% at the end of 9 months financial year 18. Card fees grew strongly by 37% YOY during the quarter, also partly influenced by a low base in the third quarter last year. Internal customers continue to be the mainstay of the bank's strategy for sourcing retail loans. 72% of sourcing in the third quarter was from existing customers. 96% of the bank's credit cards and 76% of personal loan originations in the quarter were from existing customers of the bank. 51% of overall sourcing happened through our branches. Given our internal sourcing strategy, We believe that branches remain essential for new customer acquisition and hence continue to make investments in developing an extensive branch network. We opened 104 branches during the quarter. However, the new branches continue to get smaller in size. Axis Bank continues to rank among the most valuable brands in India, ranking in the top 10 in this year. Our leadership position in transactions in the payment space also continues. Digital payments have always been a key strategic thrust for the bank, particularly over the last couple of years. We have emerged over this period as a leading partnership-driven innovator on different payments use cases. The bank has partnered with marquee names like Google, IRCTC, LIC, Uber, Ola, IOCL, BPCL, Future Group, Reliance Digital, etc. to drive acceptance of payments on the UPI platform. If you refer to slide 30, you will notice that the bank has a strong market share across almost all digital and new technology payment products. Our market position in the mobile banking space improved during the quarter, and the bank now tops the market share table, both in terms of transaction value and transaction volumes as per the latest RBI data. Mobile banking spends in the third quarter reported a growth of 71% on a YOY basis, led by a 219% growth in transaction volumes, predominantly on account of a surge in UPI transactions. The bank had 4.2 million credit cards in force at the end of the quarter, making us the fourth largest credit card issuer in the country with a market share of 11%. Credit card spends in the third quarter increased by 59% year-on-year to 11,725 crores, and debit card spends grew by 4% year-on-year to 8,722 crores. The bank is the second largest acquirer of point-of-sale terminals in the country with an installed base of 4.7 lakh point-of-sale terminals. We also continue to witness strong traction in the adoption of digital channels by customers. Please refer to slide 34 in the earnings presentation. You will notice here that 56% of the bank's active customers are digitally active. 38% of our mobile banking customers actually use only the mobile app to bank with us. Mobile banking logins are now almost 5 times that of internet banking logins. The total number of debit and credit card transactions at POS terminals and e-commerce channels continue to be much higher than the total transactions witnessed on ATMs, a phenomenon that only started a few quarters ago. Overall digital transaction volumes increased by 15% on a YOY basis, while branch transactions continue to trend downwards. If you flip over to slide 36 and 37, these highlight our capabilities and strong positioning in the Unified Payment Interface, or UPI space. We were among the first 4 banks to go live on NPCI's UPI ecosystem with the launch of Axis Pay UPI app that has seen tremendous response, with over 6.5 million virtual payment addresses being created across various apps. In the third quarter of financial year 18, Axis Bank processed over 95 million UPI transactions, amongst the highest in the industry with a 29% market share. We currently have 9.5 million registered customer base. During the quarter, the bank also launched instant international payment services using Ripple's enterprise blockchain technology. Axis is the first financial institution in India to offer Ripple-enabled frictionless payments experience in this space. This would make international remittances faster and more transparent for the bank's retail and corporate customers while ensuring security and improving overall efficiency. The acquisition of FreeCharge, which was completed in the second quarter, has since settled down. We continue to believe that the FreeCharge unique value proposition in the digital payment space and the strength of its acquisition engine would help build the Axis franchise further and create significant value for the bank in the future. All post-acquisition activities at FreeCharge remain on track. All top-line metrics since acquisition have improved materially, with total payment volumes up 42% and monthly active users increasing by 24% since our acquisition was completed. In the corporate segment, our focus in recent years has been on 4 areas: reduce concentration risk, build a higher rated lending book, increase the share of working capital loans and transaction banking revenues, and prepare for a move towards deeper bond markets through our DCM franchise. In line with these focus areas, you will notice on slides 43 through 47 that corporate credit growth has been led by transaction and working capital-oriented businesses. The working capital loan book grew strongly at 49% YOY, while term loan book grew by 1% YOY. Incremental sanctions have been to better rated corporates, with 85% of these rated A or better. At present, 74% of the outstanding standard corporate exposure is to companies rated A or better, which compares to 65% a year ago. The bank's exposure to top 20 borrowers as a percentage of Tier 1 capital has been steadily declining and stood at 107% at the end of Q3 compared to 287% at the end of financial year 11. The bank's debt and capital markets platform continues to be a market leader. The bank's share in the Indian bond market for the quarter stood at 20.3% compared to 19.6% for the same period last year. Axis Bank continues to top the Bloomberg League tables for corporate bonds for the 10th consecutive year, and we have been awarded the Best Bond Advisor Domestic in India at the Asset AAA Country Awards of 2017. We believe that our leadership here positions us very well to benefit from the growth in the corporate bonds market. In the SME segment, the focus has been to drive growth while ensuring quality of the book. Our SME loan growth improved during the quarter and stood at 27% YOY, partly aided by the low base at the end of December 2016. The growth was broad-based, as term loans and working capital loans both grew by 20% and 29% YOY respectively. Share of working capital to overall SME loan book currently stands at 78%. The GST-related uncertainty seems to have abated, with improved growth visible in the segment. Our focus here remains on building a highly rated SME book, presently where 87% of the outstanding standard exposure is to clients rated SME 3 or better. Let me move now to asset quality. Gross slippages for the quarter declined to 4,428 crores from 8,936 crores reported in the second quarter. Net slippages stood at 420 crores in the third quarter. Gross slippages in the corporate segment stood at 2,980 crores, while that in retail and SME stood at 934 and 513 crores respectively. Net slippage before write-off in retail and SME stood at 599 crores and 166 crores respectively. As on 31st December 2017, the bank's gross NPA and net NPA levels reduced to 5.28% and 2.56% from 5.90% and 3.12% as on 30th September 2017. Recoveries and upgrades during the quarter were at 4,008 crores, while write-offs were at 2,822 crores. During the third quarter, the bank recovered substantial amount in cash from an account in the IT/ITES sector and also upgraded one account in the steel sector. These two accounts were part of the 9 accounts that were reclassified by the bank in the second quarter of financial year 18. If you refer to slide 52, you will notice that during the quarter, 93% of corporate slippages came from the low-rated BB and below pool. The outstanding amount in the BB and below pool at the end of this quarter includes the outstanding amount of the steel account upgraded during the third quarter, as mentioned before. Moving on to slide 53, as on the 31st December 2017, the bank's total loan amount outstanding against the IBC accounts mentioned in the two lists referred by RBI has declined by 14% compared to the amount outstanding as on 30th September 2017. The bank has also made incremental provisions of 237 crores against these accounts during the quarter, taking the total provisioning towards these select accounts to rupees 4,123 crores, resulting in an increase in the provision coverage of these accounts to 68%. Credit costs for the quarter and for 9 months of this fiscal stood at 233 basis points and 250 basis points respectively. We expect credit costs to remain in the guided range of 220 to 260 basis points for fiscal 2018. and start trending towards the long-term normalized levels by the second half of financial year 19. The bank increased provision coverage ratio by 600 basis points during the quarter to 66%. As mentioned before, we expect to maintain PCR in the 60 to 65% range on a steady basis. Let's now touch upon our capital levels and shareholder returns. During the quarter, the bank raised equity capital of 8,680 crores through a preferential allotment to strengthen CET1 ratio while supporting future growth plans. Our total capital adequacy ratio, including 9-month FY18 profits, continues to be healthy at 18%, with a Tier 1 capital adequacy ratio of 14.13%. This compares with the Tier 1 ratio of 12.36 at the end of 30th September and 12.99 as of 31st December 2016. Slide 58 of the presentation lays out the impact of various items on our Tier 1 ratio over the 9 months of fiscal 2018. Fresh equity capital raised contributed 173 basis points. Seasonal one-off items consumed 24 basis points. Growth consumed 43 basis points of Tier 1. Fresh additional Tier 1 bonds contributed 70 basis points, and profits contributed 50 basis points, making for a net accretion of 226 basis points of capital for the 9 months of financial year 18. Risk-weighted assets for the bank at the end of this quarter stood at 497,344 crores. The proportion of RWA as a percentage of total assets improved to 77% during the third quarter compared to 78% at the end of the second quarter. Return ratios have seen moderation due to higher impact of provision costs and an increase in the net worth post the capital raised in the third quarter. Annualized ROE and ROA for 9 months FY18 stood at 6.38% and 0.53% respectively. We expect these ratios to improve as the bank leverages the capital for future growth, and we expect to see normalization in credit costs. Moving on to the performance of our key subsidiaries. The bank subsidiaries have started to scale to a level where they are now able complements to the bank's overall strategy. They are also starting to contribute materially towards creating dependable alternative revenue pools for the bank. Axis Finance is our fast-growing NBFC and complements the bank's strategy by offering financial solutions to retail and wholesale customers who have unique financing requirements. The loan book grew here by 82% YOY in the first 9 months. Revenues in these 9 months grew by 27% to 529 crores, while PAT grew 32% to 155 crores for the same period. Axis Capital is the institutional equities and investment banking franchise of the bank and has been the leader in equity and equity-linked deals over the last decade. Axis Capital executed 15 transactions during the third quarter, including 7 IPOs, 2 QIPs, and 1 mega buyback deal, among others, taking the total deals count to 33 for the first 9 months of the fiscal. Out of the 15 IPOs of more than 100 crores that came out in the third quarter, Axis Capital was associated with 7, and it successfully co-managed the 2 mega IPOs in the insurance sector. Revenues in the 9 months grew by 28% to 262 crores, and PAT grew by 37% to 121 crores for the same period. Axis Securities is one of the fastest growing stock brokerage firms in India and currently ranks among the top 3 brokerages in the country in terms of the client base. The cumulative client base rose 39% in the first 9 months of the fiscal to 1.73 million. Total revenues in 9 months grew by 30% to 676 crores, with a 21% increase in broking revenue, while PAT grew by 33% YOY to 40 crores for the same period. Axis AMC, our mutual fund business, continues to perform well. The AMC reported 50% YOY growth in average AUM for the first 9 months of the fiscal, led by a 23% YOY rise in the number of client folios. Revenues for the 9 months grew strongly by 44% YOY, and profit after taxes for the same period grew by 8% YOY. Invoice Smart, this is a subsidiary we have not spoken about in the past. Axis Bank, in partnership with M Junction, was one of 3 entities allowed by the Reserve Bank of India to set up the Trade Receivables Discounting System, or TREDS, which is an electronic platform for facilitating cash flows for MSMEs. Our digital invoice discounting platform, Invoice Smart, for MSMEs has done exceptionally well since its inception a few months ago, with a market share of nearly 50% amongst the 3 TReDS platforms active today. We currently have more than 250 participants on the platform, including multiple financiers, and have clocked more than 200 crores in finance throughput by discounting nearly 7,500 invoices. As I close, allow me to re-summarize the key themes of the quarter. Loan growth momentum has picked up across all segments. Retail franchise remains strong with a steady CASA and robust retail loan and fee growth. OPEX growth is moderated and core operating performance remains healthy. Key asset quality metrics have moderated during the quarter and provision coverage has increased. With that, I come to the end of my comments and we'd at this point of time be glad to take your questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Mahrukh Adajania from IDFC Securities. Please go ahead.
Yeah, hi. Just in terms of your BB portfolio, there has been a gross increase of around 30 billion, of which 10 billion is explained by the upgrade of the account. So excluding that, also there's around a 20 billion increase in the BB portfolio at the gross level, right? If you don't consider slippages.
No, Mahrukh, the BB portfolio was 15,800 crores or thereabouts at the end of last quarter. At the end of this quarter, it's 16,100 crores or thereabouts. So there's an increase of about 300 crores. We know that there is a roughly 1,200 crore addition to the pool in this quarter in the form of an upgrade that happened, which was not part of the base last time, but is part of it this time. So what has happened is that the upgrade from NPA pool increased BB and below by about 1,200 crores, give or take. There were slippages, which were roughly in line, not slippages, downgrades, which were roughly in line with what we have seen in prior quarters. Between downgrades and balance changes of existing BB accounts, that's give or take about 2,000 crores. And the rest is slippages out of BB and below. So that's the broad math. Roughly 2,000 crore downgrade plus balance movement, which adds to the pool. 1,200 crores roughly of the upgrade of the steel account, which adds to the pool. That's 3,200 rough addition. About 2,800 of slippages out of the pool with a net flow of about 300-400 crores.
Got it. So, but you're saying that the 2,000 crore of downgrade, that's the normal run rate per quarter in the past few quarters.
Correct. In the last 4 or 5 quarters, we have seen about 2,000 to 2,500 crores of downgrades. This is broadly in line with that.
Got it. And any specific sectors, or it's a broad-based thing?
Power it has been among the larger ones, but I wouldn't say that it is dominated by it. But certainly, it's the power sector contribution is about a third of that.
Got it. And in terms of security receipts, what's the outstanding number this quarter? And have you sold any assets to the ARCs? And what assets, like were these standard or fresh slippages or existing NPLs, if there was a sale?
We have not sold anything to ARCs in this quarter, and the SR pool is about 3,000 crores, unchanged from prior quarter.
Okay, so other than the 2 upgrades, also the recoveries were strong.
Yes.
We have sold assets in the market.
Sorry?
We have sold assets in the marketplace. There are funds who are interested in buying assets, and those are things which have happened.
Okay, but those would be NPLs or?
NPLs.
NPLs.
All right, and the reduction in the NCLT list, where you talked about 4 accounts, those were all NPLs? And would this be a system-wide thing?
Yes, they were all NPLs for us. There are 4 accounts that have reduced. One which was a sale transaction for us. There are other 3 accounts which were part of the second list, where RBI had said that if you find resolution by the 13th of December, they don't need to go to IBC. Otherwise, they need to go to IBC. There are 3 accounts in which some resolutions have been found by the lenders, and that's why they don't show up in our IBC list anymore.
Sorry, and the amount of NPLs you sold in the market, that would be the balance, right? Means 20 billion or 2,000 crores or so from the recovery and upgrade. Is that the right way to look at it?
It's a little bit less than that, Maruk.
Okay.
Yeah.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vishal Goel from UBS Securities. Please go ahead.
Hi, Jairam.
Hi, Vishal.
So I think the question is this downgrades into the BB and below list, which I think you also mentioned has been around 2,000 to 3,000 range. Now, what is the visibility over here? Since I don't know whether it's already matured list or, if you keep seeing this kind of downgrades, then like these provisions can continue.
Yeah, I think it's now been about 5 quarters that we have seen roughly the same range. At this point of time, I must admit, we're not seeing there is no evidence at hand right now to say that this is immediately going to start reducing. However, if you look at the overall pool of BBB, which is essentially the source from where these downgrades are happening, that BBB pool is now starting to come off. And there's a chart in our presentation where we show the overall split of the corporate book, and you see that BBB pool, which used to be 24% of our standard assets, is now down to 17%. So as the BBB pool itself has come down, at this point of time, you start thinking that okay, maybe the downgrade from BBB to BB is starting to wind down, and it's starting to reach its.
Okay. And just like some understanding on how we think about provisioning going forward. So we have this 16,000 crore of, let's say, BB and below. Let's assume that if it were to even remain static for the time being. Now, how should we expect, like the resolution or recognition of this? Should we expect it to happen over next 1 or 2 quarters, either below the line or above the line in P&L? Or should we expect a 3 to 4 quarter drawn out, provisioning?
Okay, I'm not sure I fully understood your question, but let me take a shot at it. See, BB and below is the pool of stressed assets. The first, before provisioning, is sort of recognition or actualization of stress into NPA. That NPA formation is likely to happen over the next 2-3 quarters or 4 quarters or thereabouts. And by that time, you should see much of this downgrade, their conversion into NPAs, etc. You should start seeing a reversion towards long-term means in that time period. And as our philosophy with respect to provisions has been to pay as we go, i.e., as you see the downgrades, you will simultaneously see the provisions come in as well. So you will see the provision ratio around that 60 to 65% kind of mark, making sure that all these downgrades and further slippages from there are immediately accounted for in the P&L.
And a related question to this only, like, do you think the IFRS is happening in March or April, or you think that it is getting delayed?
Let's keep that happening. It's very difficult to comment here. It's already too late. So if the longer it takes, the tougher it is to be implemented by April 2018.
Okay, great. Thank you. All the best.
Thanks, Vishal.
Thank you. The next question is from the line of Manish Karwa from Deutsche Bank. Please go ahead.
Yeah, hi, Jairam.
Hi, Manish.
So this NPLs that you have sold, to various funds, this is on cash basis, and I assume there is no recourse to you.
All of them are on cash.
All on cash, no recourse.
Okay, and whatever provision that needed to be made is done. And it's a part of the provisions that you would have done.
Can't do anything else.
Of course.
Okay. And second, do you hold any contingency provision?
At this point of time, no. All the contingency provision has been used up over the last few quarters.
Okay. And lastly, now the watch list is going to wind down by next quarter. So a fair assumption would be that whatever is pending in the watch list will probably become NPL, since it's been time we haven't found much of a resolution on the remaining portion.
No, actually, the way to think about it is whatever, if some part of the watch, we have about 5,300 crores of watch list left. If some part of it becomes NPL in the next quarter, the watch list will reduce by that amount. Whatever is remaining, we will start treating it as sort of business as usual pool and stop the separate watch list disclosure that we have. The accounts will still remain. The accounts will take whatever time they take to either get resolved or become normalized, whatever, but the amounts themselves become at this point of time too immaterially small in the context of a 6.5 lakh crore balance sheet. Separately tracking a 4,000 crore pool doesn't seem to be entirely productive. So we would wind down the watch list as a construct at the end of next quarter, but those accounts themselves will remain.
Oh, okay. And then a similar question to watch list. Now, you gave a breakup of your watch list in terms of which sectors they are in. What would be the top 3-4 sectors of the triple B loans that you have?
Very similar.
Very similar. As in power will have a disproportionately higher share of triple B as well?
No, power is power in double B and below
Double
book.
B and below, sorry, yeah.
About 35%. So power, iron and steel, infra are going to dominate the double B and below list as well.
Okay, and three of them put together would be what, 60-70% around?
60+%, yes.
Okay. Okay. Thanks. That's all for me.
Thanks, Manish.
Thanks.
Thank you. The next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, Jairam. Question on the margin trajectory. How do you see it panning out over the course of next 12 months?
Broadly, we think we have bottomed as far as margin is concerned. At the risk of sounding making too strong a comment here, I'll say that there are 2 or 3 things that are working in favor of margins. Of course, we have continued to see margin compression through most of this year, and we are at about 19 basis point compression compared to full year last year. We had guided for a 20 basis point compression in full year. We should be comfortably within that range at the end of this year. There are 3 things happening in the market. One is, of course, the tightness in liquidity, which creates a little bit of pricing power for banks. So you should see that in the next quarter. The second is the improvement in our asset quality numbers, which as they progress, you will start seeing a higher proportion of assets being interest earning. And the third is, of course, our recent capital raise. All 3 of these are NIM expansive, and you might start seeing all of their cumulative effect come into play in the next quarter and see certainly stabilization of NIM and hopefully a little bit of an increase.
Sorry, can I miss the second point that you mentioned? Where will you start accruing margin?
Sorry, second was the reduction in the proportion of non-interest earning assets. So if your net NPAs come down, net NPAs plus SDR, etc., come down on that pool, you were not earning any interest.
Right.
So that if that zero interest earning and hence negative margin pool reduces as a proportion, that is NIM expansive.
So, actually, that was the second question I was going to ask. So, for the first time, we are now seeing an absolute gross NPL kind of come down. Now, is that a permanent inflection point that we have seen, or do you think we might see a bump up in future?
We are cautiously optimistic. Let's leave it at that.
Right. A couple of data points, if you could have, like last quarter, if you could, give a broad breakup of that power sector distribution.
Power sector distribution, there have been a few different sort of moving pieces on that, Nilanjan. The overall pool itself has come down because a few accounts have paid down. The overall pool is now down to roughly 16,000 crores. So the pay down has been 1,000 plus crores during the course of the quarter. The double B and below pool is about 36% and triple B is about 30%.
Right. And could you have the non-fund exposure to the IBC list and as well as the BB and below?
Small. It's very small. It's a couple of 100 crores.
And in the double B and below?
Double B and below, maybe a 10% of this pool you can add. I don't know the exact number, but it will be roughly of the order of 10%.
Right. Great. Thank you so much. Thanks.
Thank you. The next question is from the line of Adarsh Parashurampuria from Nomura. Please go ahead.
Hi.
Adarsh.
This question on, you sold some of these loans, right? If you can just talk about, these are like indications of some haircuts that you've taken. So if you can just talk about what were the levels of haircut broadly implied through these sales.
The haircuts are clearly when we have an NPA and such going through a process, we have a fair idea of what we believe is fair value, what is expected. So some of these things we took a call that rather than go through the process, if we're getting fair value which we believe is available in the marketplace, I think we just did that. So broadly, if you look at one of the large loans which we sold, I think the haircut was close to 40%.
And as you maybe this is one of the steel names, but as you get beyond the steel names, right? What would be your expectation of haircut? I think steel, because of the environment, things have changed, but otherwise, what's your expectation as we get more closer to seeing some of these in the March and June quarter?
If you look at what's happened in, say, Binani, there was no haircut. In textile, there'll be much larger haircut. So I think it's very difficult to say as a pool what you expect. I think, like you're saying, steel, we have something. In some other sector, maybe possibly much higher. Construction should be very, haircuts could be much larger. So I think, it depends if it's cement or something, for haircuts, it could be much lower. So I think sector specific, yeah.
And just from a write-off perspective, you all have been writing off a lot of loans. So, what's the recoverability pool from that? So some of this could be accounting related. So you would think that, the way you report your provision is the right way and you all are comfortable with that, or the write-off pool will eventually have a much larger haircut. So.
See, the way, Adarsh, we've talked about this a little bit in the past. The way we think about it is all accounts that go into NPL, we assess them for LGD buckets. And there will be some low LGD bucket, there will be some mid LGD bucket, and there will be some high LGD bucket. And we try to slope our provisioning accordingly. On an overall basis, we expect LGD somewhere around 60%, and hence we would like to keep provision coverage in the 60 to 65% kind of range. Now, this takes into account both the low LGD accounts as well as the very high LGD accounts. And in those very high LGD accounts, we have gone ahead and made 100% provisions, and we go ahead and do prudential write-off of them so that we can take the taxation benefit of doing that write-off. So yes, our belief is that when you actually look at LGD and compare that LGD to provision coverage, because you're using the high haircut accounts for LGD calculation, you should also take into account the high provisions you have made on those self-same accounts in the form of 100% provisioning and hence prudential write-off. And hence we believe that the 65% calculation or 66% this quarter calculation that we do, which includes all those accounts where we have made 100% provisions, that is the right way to actually look at things.
So broadly on coverage, you're relatively where you would like to remain for some time.
We have said in the past that our sweet spot, we believe, is somewhere in the 60 to 65% kind of range. Last quarter, we had fallen to the bottom of our comfort level range, which is at 60%. This quarter, we have bumped up coverage and we have sort of exceeded the ceiling a little bit. We have gone to 66%, but broadly, we plan to be in the 60 to 65 range on a steady basis.
And last question is, given the amount of, A+ accounts being built in the corporate book, and the retail proportion in the overall book, while you expect to get to normalization, in the second half of next year, just taking a 2 to 3 year view, given the construct of the loan book, is it very natural to expect undershooting to happen after that on, in terms of credit cost, given the kind of book being built now? Is that a...
Yeah, I think, it's fair to there's a factual statement you can make, which is that the last 15-16 year credit cost chart that we show in our earnings presentation, if you were to de-average that chart by corporate, retail and SME, you would indeed see that through the cycle, 17-year average credit cost for retail would be the lowest, and SME and corporate would be roughly similar at a slightly higher level. And hence, if your book moves towards a book composition moves in such a way that retail is higher going forward, then there is a reason to be cautiously optimistic about what the go-to average as far as credit costs are concerned. But let's wait and watch how that plays out.
Perfect. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah. So the question is with respect to if we look at the waterfall.
Excuse me, this is the operator. Mr. Kunal Shah, can you come closer to the phone, please?
Yeah, sure. So if we look at the waterfall for NIMs, hardly the impact of interest reversal is 3 odd basis points. So maybe maximum of it is also come from RBI's divergence this time. So how has been the servicing? Maybe prior to that, obviously it was more kind of a servicing account, and maybe on a receipt basis we would have accrued interest. But post this classification of NPL, have we seen the change in the behavior of the borrower in terms of the payment on this RBI divergence account, apart from two which has got upgraded?
No change. I think the accounts, irrespective of classification because of RBI divergence, the accounts were paying, they continue to pay.
Okay.
Because just downgrade in one bank doesn't mean that it'll stop paying everyone.
Okay. So that's so maybe even if you look at it in terms of the unwinding, so unwinding has not been the major cause for the decline in the margins which has been there in the first 9 months. It has been broadly on account of decline in yields, which could be either loan mix or competition. And so do we see this continuing for a while and the pressure on the overall yields to continue?
Yeah, no, I think your assertion is right that the margin compression over the 9 months in this financial year are driven by yield compression, not by increased credit risk in any sense or any of the credit risk metrics. The yield compression, I mean, I said during my opening comments that we have seen 19 basis point of compression compared to last year. Our full year guidance is about 20 basis points. We remain fairly confident that we will be well within that range.
I think what Jairam said earlier was the proportion of non-interest earning assets is coming down. And I think that is what is going to help your NIM. That is what he said.
Okay. So maybe in terms of the improvement, we should not say, but it should stabilize at the current level.
You got capital. He told you 3 reasons.
Yeah, capital.
There was a pull up there.
Okay. Yeah, thank you.
Thank you.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Nitin?
Yeah, hi. I'm audible?
Yes.
Yeah. So I have one question on the working capital loans. So that piece is like growing at a very rapid rate for us. So what sort of working capital loan mix are we looking at in the corporate portfolio? And how much of this growth is coming by way of like organic, and how much is like any buyouts there?
There's no buyouts as such. I think we try and get into good working capital consortiums, and the utilizations will depend on market conditions, and that's what we're seeing happening. So there's no inorganic. I don't know what you mean by organic. Everything is organic. I think we approach the corporate, get into the working capital consortium by offering him whatever we believe is value for him.
So this is like more coming in by way of refinancing, or are you seeing signs of fresh demand also in this space?
Both. I mean, I think it's difficult to say that I will take over someone else and the other bank will be moved out of the consortium. It doesn't happen that way. Every corporate has an increase in working capital needs year on year, and you try and fill up that gap as and when possible.
And related to this, do you think that there will be any margin implication from this change in the loan mix in this space, moving from term loan to altogether towards working capital in the long term?
It gives you a more steady asset base in terms of trying to say that if you have more and more working capital lines, at any point of time, I think the amount it will get drawn down by you are a lot more confident in terms of utilization and asset build-up.
Okay. And secondly, on the watch list, like which is dominated by PAR assets at 67% of total watch list, is it possible to share like the composition of under construction and operational assets, and what sort of LGDs one can work with in this space?
It is too small. I mean, you're talking about 2/3 of a 5,000 crore book. Breaking that even further, I mean, we could do it, but I mean, we just don't have it readily at hand. I think it's too small.
All large power projects are operational right now.
Right. So, because you said that of the total BB and below, nearly 35% belongs to PAR. So, right, which is almost like 5,000 odd crores.
Oh, so you're talking about the BB book. You started off saying watch list. That threw me off a little bit. If the information that, I mean, we shared, if you remember a slide last quarter on what the composition is in terms of under construction versus fully constructed, etc., that is materially the same. Nothing much has changed on that front in this quarter.
Okay, sure. Thanks so much.
Thank you.
Thank you. The next question is from the line of Arish Aritana from India Infoline. Please go ahead.
Yeah, hi, good evening.
Hi.
Yeah, just want to know if you could tell us a little bit more about the slippages in retail and SME and why they are higher than usual and any particular products or reasons that are attributable for this.
Nothing very specific. I think, it's just a little bit more visible now that corporate slippages are a little bit lower. But no, you will, there's no big event like the agri event that happened in the first quarter of this year or anything of that sort. We haven't seen anything of that nature. This is sort of a broad distribution right now. As you know, we have a very broad swathe of products in retail. There's no particular concentration of the slippages that we saw in the third quarter. Hello?
Mr. Aritana, do you have any more questions? So there seems to be some disturbance from the line. We move to the next question. That's from the line of Ravikant Bhatt from Emkay Global. Please go ahead.
Hello. Am I audible?
Yeah, yes, Ravikant.
Yeah. So just a couple of questions. One is on the operating expenses. Now, if one were to look at broadly how the employee and non-employee expenses have grown over the last few years, clearly the non-employee OPEX has accelerated. And if one were to look at the 9M period, your non-employee OPEX growth has been almost twice that of employee OPEX. Now, if one were to look at the OPEX, then how do you think it's broadly going to increase going forward? Because the pace overall has come down, which you also noted in your presentation at the outset. So if you could just give an indication how we can expect this line to move.
Sure.
And yeah.
So the big thing that I'd note here is that third quarter was a quarter in which on a gross basis you saw a reduction in our employee base, a fairly material reduction in our employee base. This is the first time in the last multiple quarters that we have seen a material reduction in the employee base, and as you can imagine, that translates into much lower staff OPEX compared to what it has been in the past. Clearly, some of the benefits of digitization at the front end, as well as more particularly digitization of the back office, are starting to have an impact, and you're seeing that in the form of a reduction in staff OPEX. Now, as far as non-staff OPEX is concerned, that does tend to depend a lot on business volumes and throughput, and you're seeing that growth. Overall, if you see OPEX, we started the year at a YOY growth of roughly 20%, which reduced to 19% in the first quarter, 14% in the second quarter, and is now at 12% in the third quarter. So clearly, from a trajectory perspective, overall OPEX is continuing to come down, and the jaws are getting more and more efficient.
Okay, fair enough. And the second question is on the again on the loan growth, the working capital thing which you have articulated. If you could just list maybe 2 or 3 factors which might be driving the working capital demand, whether it's commodity inflation or rising capacity utilizations, and where this is exactly coming from, or is it just that you're gaining market share?
It is just gaining market share. I don't think so. We are saying that suddenly the working capital pool is suddenly grown substantially for us to say that this is going to be something which we have it's not. It is basically taking share away from other banks. Let's leave it there, because where we are saying is that any incremental working capital we participate, but out of the overall utilization we tend to get a much higher share because of our competitiveness and our customer service.
Sure. And just a related question, if you could just elaborate how trades could if trades would have any relation to your future to the future performance on the loan growth. If there's anything, any number that you could share over there.
Trades has not got anything to do with our loan growth. Clearly, trades is basically receivable financing for MSMEs, and whatever receivables they have, that goes on a platform where other financiers, including Axis, can finance. So that is not something which will have any impact on our loan growth. I think that's an independent platform. It's neutral to Axis.
What we hope to do is, as service providers for MSME, we would want to make that market of MSME receivables discounting. And if we are able to do that, then you become the platform of choice and you become the aggregator of a lot of information and data on the kinds of transactions that are happening out there. And over time, you can actually figure out how to monetize that data. But this is not at this point of time meant to be an SME loan growth enabler. At this stage, it will take a while for it to get there.
Sure, thanks, Jairam. That was useful.
Thank you. The next question is from the line of Sri Shankar R from Prabhudas Lilladher. Please go ahead.
Hi. A quick, most of the questions got answered, but a quick one or two things. You mentioned in your presentation about the personal loans, etc., sourcing from your own clients is dropping. Do you think that is probably going to lead to some kind of a risk in your the credit that you're giving, the personal loan side?
I think I might have either I misspoke or you might have misheard a little bit there. Personal loan sourcing, etc., from branches continues to be on an upward trajectory. We continue to believe that sourcing from our internal customer base is indeed the best form of sourcing that we can do. There is a marginal decline from 78% to 76%. On a quarter-on-quarter basis, if you look at the percentage of personal loans that are sourced from internal customers, but that increased delta has also gone towards a pre-selected whitelist of companies in the country whose employees that we have created personal loan products for. So it isn't sort of open market in the traditional sense. It is sourcing to a whitelist of companies whose salaried employees we sell to.
Okay, that's helpful. Your corporate loans have seen an increase of roughly around 12%. That's again, you mentioned about in working capital led. So the increase, which is probably, we've seen a lot of commodities. Is it the gain coming from the inability of the PSU banks to lend in the incremental credit requirement, or where are these gains coming from?
As I said, it is to some extent gain in market share from other banks, which could be primarily PSU banks. Because overall, if you look at the credit expansion, it is, it's clearly not to the degree which you're talking of for increase in working capital loans.
Okay, and finally on, Jairam, in your opening remarks, you did mention that your credit costs you expect to remain, or rather start reducing in the second half of FY19, correct?
We said that we expect credit cost normalization by the second half of FY19, and by normalization I was indicating a reversion on a run rate basis to our long-term averages of about 100 basis points of annualized credit cost.
That's right. Okay. Thanks. That's helpful.
Thank you.
Thank you. The next question is from the line of Prakash Sharma from CLSA. Please go ahead.
Good evening, people, and good results. Congratulations. I just needed a couple of data points. One, the double B and below rated number, that's a fund-based number, right? Would you have the non-fund based exposure to these corporates as well?
Yes, that is a fund-based number, and this question had come up earlier in the call where I think Nilanjan was asking for the Maruk was asking for the non-funded number. I had misspoke at that time, I think, and this is a good opportunity for me to correct what I said. The non-fund-based exposure to double B and below is roughly 5,000 crores.
Okay, sure. And sorry if I missed it, but would you have given the numbers on the 525 and the SDR? ARC, I took it.
No, we didn't give out specific numbers. If you look at the entire pool of SDR, CDR, S4A, 525, and that whole sort of all sorts of different restructuring dispensations, that whole pool is something like 6,900 crores or something.
Okay, because what I remember is, if this steel account would have got added to the 525 construct, so that number last quarter itself was touching somewhere like 6,000 crores on a net basis adjusted for the overlaps maybe. Would that have gone up? Like, the other way to ask
the steel account was always 525 even before.
Okay, even as you classified it as an NPL.
It was 525 from December 15.
Okay, sure. That's good for me. Thank you so much.
Thank you. The next question is from the line of Krishnan ASV from SBI Cap Securities Limited. Please go ahead.
Yeah, hi. Put many thanks. Two things from my side. Number one, could we be at a stage for a while now where where Axis Bank's MCLR actually begins to trend up, but base rate needs to necessarily adjust lower? I mean, that could happen for the rest of the system as well, but do you envisage that happening with Axis Bank? Given that base rate on an average cost basis would adjust lower for a while longer, but your MCLRs may actually start trending up.
Yeah, no, it's logical. What you're saying is logical. It's possible.
Right. And so then what happens? I mean, in terms of the regulators' demands on what a bank can do in terms of your ability to coerce borrowers?
We'll do the math, yeah. That's all we can do.
Yeah, I mean, how the regulator will react to that is, I mean, we are the wrong people to ask.
Okay, so that's one. Number two is more to do with recent inputs that have come from different regulators to you to the bank as an institution. I mean, could you just elaborate on what actions you have been taking, please?
Yeah, I mean, there have been conversations that we've had with some regulators in terms of investigations that they've requested the bank to take on. All those are progressing well, and we are in constant touch with the regulators on that. At this point of time, there is nothing to report to the broad investing public.
Thank you.
Thank you.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Yeah, good evening to all.
Hi, Mahesh.
Good evening, sir. Just 2-3 questions. One, just a reconfirmation on the asset sales of NPLs. You did a all-cash transaction, is it, in this quarter?
Yeah.
And just trying to understand the broad logic behind, given the fact that you're in the fag end of this entire resolution of those accounts, what kind of drove you to this decision, given that the expression of interest on some of these accounts were pretty good?
Well, we know what a sustainable debt is, what we believe is sustainable, and what we know what approximately will be the haircut. And if you're getting fair value based on that, we believe it's the right thing to sell.
Okay. So just a second question. This is to probably to Rajiv. The portfolio on the retail side, if you could just broadly give us some color between is there a big difference between the average yield of the portfolio and the yield at which you're placing the underlying assets at? And second, in the underlying growth that you're seeing in the retail side, how much would be driven by new to credit customers, probably in the personal loans and the housing loan side, or is it essentially refinancing which is driving this? Or are you seeing a genuine pickup in underlying transactions on various asset classes? Thanks.
So let me take the second question first, because the entire focus as far as retail is concerned is to granularize the business and is focused towards serving existing customers. So therefore, over 51% of the sourcing is from branches, and approximately about 72% of sourcing is to our existing customer base. And I think that is something that we will continue to focus on, especially given the fact that we continue to have strong customer acquisition on the savings account side, both from the open market as well as from our salary franchise. The first one I didn't quite understand.
Yeah, if in the first one you were looking to see whether the average retail that we are onboarding today is net accretive or depletive of the gross yields, I'd say that on a net basis, the new retail book is accretive to margins, and yields are higher than portfolio yields by about 80 basis points.
Thanks for this. But just a question again on the first one. So we're just trying to understand, are a lot of these new to credit customers, or are you seeing a fair amount of refinancing opportunities coming in as they are onboarding as your savings account customers?
So particularly on our personal loan and credit cards, we do get a significant component of new to credit. However, the composition of refinance, particularly on home loans, that would be a larger component for the home loan side as opposed to personal loans and credit cards.
Would that number be greater than 50?
No.
For refinancing?
No.
Okay. No. Thanks a lot.
Thank you. The next question is from the line of Jay Mundra from BNK Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So first thing on the warrant. So I wanted to understand, we have issued a warrant. The pricing I believe is 565. But if you can specify the time limit for the exercise of the warrant.
18 months is the time limit. Expires in June 2019.
Sure. And the second question on retail slippages. Did I hear it correct that when you said 900 crores of retail slippages are more or less the usual run rate because it does not include any unusual thing from any other product or geography?
No, there isn't anything unusual, though there are seasonality elements in retail always, but no, there isn't anything particularly unusual.
So because if I translate this on the base, then it is somewhere around 2% on annualized basis. So that is why I was just...
Seasonality elements that you need to keep in mind, don't just annualize by multiplying by 4.
Sure. Thank you, sir. Thanks.
Thank you. The next question is from the line of Siddharth Gandhi from Singhania Securities. Please go ahead.
Jairam, hi. Can you give the modified duration of your investment book between HFT, AFS and HTM?
We don't offer that anymore. There is a table in the earnings presentation towards the very end, which has some information on it. It is slide...
I think towards the end, yeah.
Exactly, towards the very end.
Carry the modified duration, that's why I asked.
It has a little bit of that, but beyond that, we are not offering any more information any longer.
Okay.
Thank you.
Thank you. The next question is from the line of Pranav Gupta from HDFC Securities. Please go ahead.
Hello.
Hi, Pranav.
Yeah, am I audible?
Yes.
So just two questions. Firstly, if I look at deposits and borrowings combined, they are flat sequentially, but our interest expenses have gone up about 4%. So any particular reason for that?
Must be a mixed thing. I haven't actually thought about it. It must be a mixing of what particular what originated. It must be some version of that. Like
what number is looking at? Try to look at the average assets and average liability.
Yeah. Srini is raising another important point, which is make sure that you're not looking just at the quarter end numbers, but average through the quarters for comparison, which you might not have readily available, but that must be the other thing that'll make a difference.
All right. And secondly, again, I believe you will allude to the average concept here, but if you look at SAR deposit growth for this quarter, it's been flat, and for other banks, offering differential rates has been higher. So could you attribute this to losing slight market share to these banks, or how should we look at it?
If you look at the market, the overall market growth, we have comfortably outpaced on SAR growth. If you look at the largest banks that have actually declared results so far, you'll see that our SAR growth is actually higher, both on a month-end basis as well as on a quarterly average basis. Higher. So yes, there are some sort of high rate banks where high SAR rate banks whose annualized growth would be higher on a smaller base, but with comparable peers, we feel fairly comfortable with where we are and have been gaining market share and continue to be steady there.
Yeah, so that is what I was asking. So I actually was talking about banks which are offering differential rates. So would it be fair to assume that there's a slight loss in market share to those banks?
Yeah, I think as you think about banks which are offering higher rates,
yeah.
I think what you got to then look at is the growth in terms of retail term deposits plus the savings, and then accordingly, sort of look at it in that context. So, because if you see the customer behavior as well, some of that customer behavior is in a sense term deposit rate, sort of kind of behavior. And so therefore, when you look at the market share shifts in that context, it's not as stark as the point that you're trying to make.
And just to make a sort of simple, mathematical assertion, which I'm 100% sure you're fully aware of, these high rate banks are gaining market share. We are gaining market share as well. Someone else is losing market share. The overall is adding up to 1. It's not like we are losing market share to them.
All right. Okay, thank you very much.
Thank you.
Thank you. The next question is from the line of Abhishek Minda from Goldman Sachs. Please go ahead.
Hi, thanks for the opportunity. So I have 2 questions on the asset quality side. Number one, you already had a provision of close to 55% on the NCLT accounts. Any specific reason you have moved that up to close to 63-65% levels?
No specific reason. I mean, we just need to make our own assessment of what is the security we have and where do we think some of these accounts are headed, and you just need to do the prudent thing. And when you have the ability, make sure that you put some money away. So no, there's no specific reason.
Okay, thanks for that. And secondly, you saw upgradation of one of the steel accounts and the recovery in the IT space. So of the remaining 7 accounts, like how do we see the upgradations going forward? Like any color on that front will be really helpful.
You should see some more coming in this quarter.
Okay. All right. Thank you.
Thank you.
Thank you. We take the last question from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi. Thanks for the second opportunity. Just want to get a color on the SME and, related to the GST impact, because you're growing that book pretty fast. So have you, kind of seen, higher transaction volume from your SME clients? And if you could be a little more specific about, which sectors are you actually seeing an improvement?
I think on SME, Jairam said in his initial remarks that if you look at the base effect, what happened last year, because of demonetization, you saw the SME book shrink through Q3.
Mm-hmm.
The number you're seeing on a year-on-year growth is clearly overstating the growth. So if you look at quarter-on-quarter sequentially, the growth is around 2,000 crores, which I would believe could be the normal run rate going forward once the GST disruption broadly is over.
But have you witnessed any change in the behavior of these customers?
Yeah, we are seeing higher proportion of transactions electronic, as we have been seeing for the last few quarters. The overall utilization of working capital limits after hitting a bottom in June, July have increased, but I wouldn't overstate it to say that it's sort of phenomenally high. But yes, certainly much better off from the bottoms hit in June, July.
Right. And the second question, I think Rajiv just mentioned one of the earlier questions. Did you mention that the incremental new to bank retail customers, the yields are 80 basis points higher than the portfolio?
Not incremental. Total book.
80 basis. Not retail, it's overall book.
The entire book or just the retail part?
No. You're comparing retail to overall, right?
I'm comparing retail to retail.
Oh, retail to retail. No. Retail to retail, if you're comparing over time, then over time yields have come off. Yields have declined in retail, just as they have declined in every other part of the business on a YOY basis. They have not come down too much because we have had a mix shift within retail towards products like personal loans, credit cards, etc., which are higher yield products. So on a product-to-product basis, yields have come down in every product. However, because our mix shift has moved us towards higher yielding products, our overall yields in retail have fallen much less than some of the other businesses.
Yeah, that makes sense. I was a bit shocked. Yeah, thank you so much.
Thank you.
Thank you. Ladies and gentlemen, with this I now hand the conference over to Mr. Jairam Sridharan for his closing comments. Over to you, sir.
Thank you very much, everybody, for participating actively in this conversation. We look forward to continuing our conversation with you guys as you deem fit. As of now, have a very good evening and thank you very much.
Thank you very much, sir. Ladies and gentlemen, on behalf of Axis Bank, that concludes this conference call. Thank you.